It's a market holiday in the US and Canada and no significant economic data releases on the calendar today, although market sentiment was hit by fresh concerns over China's outlook for growth. Moving on from last week's annual Jackson Hole gathering, investors now shift their focus to Europe's debt woes and the ECB. Joining me now to discuss the Forex market and the euro versus several other G10 currencies is Chris Walker, a currency strategist at UBS in London. First of all, Chris, how has the Forex market taken Ben Bernanke's words regarding the US economy and a future policy action? Also, is there anything in particular that has been influencing currency movement so far on this week's first trading day?
We saw a lot of intraday FX market volatility around the announcement. Sort of dollar yen was main mover initially, rallying into the meeting and then selling off quite hard, but actually coming back to where we started. So really, in essence, we haven't really seen a much feed-through impact from the meeting. I mean, the main reason behind this was that Bernanke sort of left the doors open for further easing without explicitly committing to anything in the speech itself. So the natural feed-through to that is there's a bit of disappointment, which is why sort of markets started to sell off. But still, the door is very much open and going to be contingent on the labour market. So if we get a series of soft labour market data prints, then of course the possibility of further easing and further stimulus from the Fed remains open.
Alongside policy action from the ECB, what do you think will be driving market sentiment and volatility in the FX market this week? You did just mention US jobs data. What else is there?
There's quite a lot of event risk over the next 5 days. We've got central bank meetings, of course, from the ECB, RBA, BSC as well. In terms of the event risks, coming out of these meetings, we think the crucial area will be the ECB, of course, because this has been the source of market tension and speculation that Draghi will go ahead and announce quite a bold new series of measures. Has really been the main driver behind the correction in markets, which you've seen from earlier this summer, ever since the previous meeting where he committed to working towards a new program with regards to the bond buying program. Its markets have looked upon it favourably. So we think there is scope for a little bit of rally, depending on how many details the ECB provides. But in the short term, I think it's been pretty clear that Draghi's still working on the plans, and I would not be particularly certain that the plans are actually ready. So in that sense, Euro bulls might be a little bit disappointed in the short term.
What are your forecasts for the euro dollar going forward, given your expectations for the ECB?
We see it quite sort of flat over the short term. 1 month we sit at 125 versus dollar, but we think over the next 3 months as we head into year end that should push lower. As I mentioned, once we do get details of this bond buying program through, and whether that's in terms of the part of the curve they'll be targeting, and if we do get a situation where they'll be committing to buy bonds up to the 2-year tenor, then that could have the ability to surprise markets, and we could have a bit of a rally on the back of that. But much, of course, depends on the politics. We've seen Rajoy and the Spanish government be pretty stubborn in refusing a bailout so far. So as long as that drags on, then market tension will continue to focus on Spain. And then, of course, the politics around much of southern Europe and the north-south divide hasn't really changed. So as we push into year-end, we think there'll be a re-emergence of political tension, whether it comes from Greece or Spain, whatever that may be. That should eventually push euro lower.
The consensus is for the Bank of England to stick to its current monetary policy plan when it meets this week also. What base case scenario have you built your FX forecast on for the euro pound? And as a result, how do you see this pair performing over the next 12 months?
Our forecast for year end is 77, so we see a little bit of modest appreciation of sterling versus the euro. I think in the short term there are some risks to that estimate, in the sense that the key source of sterling inflows has been heightened stress in the periphery fixed income markets. So given that these have sort of calmed down in light of potential policy responses from the ECB, then the marginal bid for the pound has started to decrease over the last few weeks. But generally, these sort of structural trends are unlikely to continue unless you take the view that the marginal buyer for European periphery debt has returns, and we don't think it probably has. We think it's just a market correction, and that bid for sterling versus euro will likely to continue. And even though the fundamentals aren't particularly strong in the UK, there are some sort of tentative signs of recovery into the manufacturing sector. So given that FX is a relative world, we do see some scope for a bit of modest appreciation of the pound versus the euro.
Finally, Chris, in your opinion, looking at the euro-yen, what do you think could be driving price movement, and what are your expectations for this pair over the short, mid and long term?
Yeah, this cross is really a sort of high beta play on Eurozone stress and Eurozone growth. We're fairly constructive on the yen going forward. I mean, the sort of capital flows element is not quite in the yen's favour as it used to be, whether that's through the trade balance or the net international investment position, but still on the margin it's going to be positive yen. So that's probably expressed by a slightly bearish yen view. We're targeting 98 over the short term, over the 1 month time frame, but that should gradually move towards 94 over the next few months. We're just saying it's a good vehicle to express a bearish euro play if people are not particularly favourable of the dollar overall, because there is a sort of inherent risk of Fed easing, which of course debases the currency. So we think a better way to play it is for euro yen. So once again, similar to euro dollar, we think there's a risk of a slight squeeze higher depending on reactions to policy response from the ECB. But over the medium to longer term, we think that the structural trend of euro yen weakening should continue.
Chris, thank you very much for your comments there and your FX projections for the euro dollar, euro pound and euro yen. We'll be covering European developments ahead of this week's ECB meeting in more detail throughout the week, so stay tuned. For the moment though, goodbye.